Okay, so as we're all looking ahead to 2025, and with markets hitting all-time highs, there's this nagging question kind of hiding just under the surface. What are the risks we're not seeing? Let's break it down.
You see this everywhere, right? The markets are hitting new peaks, and it really feels like one big party. But this quote, it just perfectly captures that growing feeling, that little bit of anxiety, this sense that while we're all looking up at these incredible highs, a risk is quietly building in the background.
So to really get what's going on, you have to see the current climate for what it truly is. It's basically a tale of two markets, both existing at the exact same time. One is all about celebration, and the other, well, it's about caution.
I mean, on the surface, 2024 has been a phenomenal year, hasn't it? We've seen these massive inflows from foreign institutional investors, the FIIs, and just this huge wave of retail enthusiasm, with new people jumping into the market every single day. And yeah, that's what's been pushing it to these crazy record highs.
But this is exactly where the story splits in two. On one side, you've got the celebration, the record highs, the massive FII inflows, but on the other side, you have the warnings. We're talking overheated small caps, the threat of global shocks, and the very real danger of emotional investing. It really seems like high markets can hide some pretty high risks. And you know what? 2025 might just be the year that whole theory gets put to the test.
All right, so let's dig into that first major risk. And honestly, it's a direct consequence of all this success. It's overvaluation. Or, if you want to put it another way, it's simply the price of popularity.
So what is overvaluation, really? Basically, it's when the price of something, could be a stock, could be the entire market, gets pushed way, way higher than what its actual fundamental value can justify. And that gap, the space between that high price and its real value, that's what creates the risk of a sharp fall, or what we call a correction.
And this is where things get interesting for India on the world stage. Using a key metric called the price-to-earnings, or PE ratio, which is just a simple way to see how expensive a market is, India currently stands out as one of the priciest emerging markets in the world. And when valuations climb this high, the market becomes extremely sensitive to any kind of shock.
And look, this risk isn't spread evenly across the market. You've really got to watch the small cap and mid cap sectors. That's where things are showing major signs of getting overheated. Prices there have just climbed the fastest, making them potentially the most vulnerable if a correction comes.
Okay, so that brings us right to our second risk. And for this one, we need to look beyond our own borders. We're talking about the potential for a chill coming from abroad, a global slowdown.
Think about it. Massive economies like the United States and Europe, they're grappling with their own problems right now. We're talking sluggish growth and pretty significant debt. All of that creates a really fragile international environment that can have ripple effects, well, everywhere.
And this is how it can trigger a domino effect. Picture this. Western markets correct because of that slow growth. What happens next? Those same international investors, the FIIs, they get nervous, and their go-to reaction is to pull money out of places they see as riskier, like emerging markets, to lower their exposure. And since India has been a prime destination for that money, we could face a pretty significant outflow.
Which leads us perfectly into our third and final risk. And this one's all about our own behavior. It's the danger of retail euphoria, that exact moment when all the market hype just overheats.
Come on, we've all seen the signs. A massive surge in so-called meme stocks, people chasing the latest hype stock without doing their homework, and just an overwhelming focus on making quick, short-term profits. These are the classic, textbook warning signs of a market that's being driven more by emotion than by fundamentals.
And it forces us to stop and ask a pretty crucial question. When the market is driven by hype and the chase for quick profits, are our decisions based on solid fundamentals, or is it all starting to look a lot more like gambling? Okay, so we've outlined the risks, but look, the goal here isn't to cause panic, it's to prepare. So let's shift gears and walk through a simple 3-step strategy for how you can navigate whatever might be coming. All right, so here's the plan. It's built on 3 core ideas: diversify your holdings, secure your foundation, and be systematic. Let's break down exactly what each one of those means.
First up, diversify. This is the classic rule, right? Don't put all your eggs in one basket. In this kind of climate, that means not concentrating all your money in those overheated small cap and mid cap sectors we talked about. Spreading your investments across different assets is your absolute first line of defense.
Second, secure your foundation. And this just means having an emergency fund. A cash reserve that you can get to easily ensures that if the market takes a downturn, you won't be forced to sell your investments at a loss just to cover some unexpected expense. It is your financial safety net.
And finally, be systematic. This means investing with your brain, not with your gut. Have a logical plan and actually stick to it, tuning out all the market noise. Resisting that urge to chase hype or to panic sell. That's what separates a systematic investor from an emotional one.
So, as we wrap this up, it all really comes down to this one question I want to leave you with. Looking ahead to 2025 and beyond, what's going to guide your financial decisions? Are you going to be driven by the hype and the fear of the moment, or are you going to be guided by a clear, systematic plan? The choice is yours.